silver just experienced the most violent crash in modern history, plummeting 36% from $120 down to $78 in less than 24 hours. Over $1.2 trillion in market capitalization completely evaporated from the precious metals market while you were sleeping. Gold simultaneously dropped below $5,000. And what makes this particularly significant is that the physical silver market is telling us a completely different story than what we're seeing in paper futures. This is Bullion Reports, and what I'm about to show you reveals exactly why institutional players engineered this crash. If you're serious about understanding precious metals markets, make sure you subscribe and turn on notifications, because the information you're about to hear is not being discussed anywhere else. Let me start by showing you the numbers that reveal what's really happening beneath the surface of this so-called market crash. While COMEX silver futures are trading at $78 per ounce in New York, physical silver on the Shanghai Futures Exchange is trading at $114 per ounce in China. That represents a premium of $36, which means Chinese buyers are paying 46% more than the paper price just to get their hands on actual physical metal that they can hold in their vaults. This is not a normal market condition, and it's certainly not what you would expect during a legitimate price collapse driven by weakening demand or deteriorating economic fundamentals. When silver genuinely crashes due to economic slowdown or reduced industrial consumption, premiums typically compress dramatically or even turn negative as physical holders panic and rush to liquidate their positions to raise cash. That's not what we're witnessing in today's market environment. The Shanghai premium of $36 is the largest physical premium in the entire recorded history of the silver market, surpassing even the massive premiums we saw during the pandemic supply chain crisis of 2020 and the industrial shortage that developed throughout 2021. Physical buyers in Asia are front-running what they know is coming down the pipeline, and they're willing to pay nearly 50% over the paper spot price because they understand something that most Western investors haven't figured out yet. The divergence between paper and physical pricing tells us that the COMEX futures market has completely decoupled from the actual supply and demand fundamentals of physical silver in the real world. We're looking at two entirely separate markets operating under completely different rules and mechanisms, and the paper market is being systematically used as a tool to suppress the price, while the physical market is screaming at the top of its lungs that silver is dramatically undervalued at current levels. Now let's examine the fundamental ratios that make absolutely no sense whatsoever if you understand basic supply and demand economics that govern commodity markets. The gold-to-silver price ratio just expanded to 52-1, meaning it now takes 52 ounces of silver to purchase 1 single ounce of gold in the current market. However, the actual mining ratio that comes out of the ground is approximately 8-1, which means that for every single ounce of gold that miners pull out of the earth, they're simultaneously extracting approximately 8 ounces of silver from those same deposits. Let me put that mathematical discrepancy in perspective so the complete absurdity of this pricing structure becomes crystal clear to everyone watching. If silver and gold were priced according to their natural mining abundance and geological scarcity, silver should be trading somewhere around $625 per ounce based on gold's current price of $5,000 per ounce. Even if we account for differences in industrial consumption patterns and apply a very conservative adjustment factor to be realistic, silver should minimally be trading somewhere in the range of $200 to $300 per ounce in a rational market, certainly not at $78 where we find ourselves today. The COMEX vault inventories reveal another absolutely fascinating piece of this puzzle that most market analysts are completely overlooking in their superficial analysis. For every single ounce of gold that's held in COMEX registered vaults available for delivery, there are currently 12 ounces of silver sitting in registered inventory waiting for potential delivery demands. Meanwhile, the London Bullion Market Association reports a vault ratio of approximately 3 ounces of silver for every single ounce of gold in their sophisticated storage system across the United Kingdom. These critical ratios are compressing rapidly as physical silver continues to get systematically drained from Western vaults and shipped eastward to Asian buyers who are willingly paying those massive premiums we discussed in the previous section. What we're witnessing is a profound structural imbalance that simply cannot persist indefinitely because the underlying mathematics don't support the current artificial pricing mechanism that's been established. Either COMEX prices will need to rise dramatically to meet Shanghai pricing and close that arbitrage gap, or the COMEX futures market will progressively lose all credibility as the primary global price discovery mechanism for silver and gold in international markets. What triggered this unprecedented 36% collapse in 24 hours? The crash began precisely when Asian markets opened for trading, raising red flags among experienced traders who understand how manipulation events unfold. Within hours, the London Metal Exchange announced technical difficulties and delayed their market opening. Think about that timing. Silver crashes violently as China opens, then the London Metal Exchange conveniently has technical issues, delaying price discovery in the world's second-largest precious metals market. COMEX then experiences a liquidation cascade as leveraged positions get margin called and forced to sell regardless of fundamentals. This pattern is identical to March 2020, when gold and silver were hammered during a period when physical premiums exploded and coin dealers were sold out. Paper markets crashed while physical markets experienced unprecedented demand, with retail buyers paying 30 to 40% premiums over spot just to acquire coins. The mechanism is simple once you understand how concentrated short positions engineer violent price moves. A small number of large institutional players hold massive shorts in silver futures, and coordinated selling at specific times when liquidity is thin creates the appearance of collapse, triggering stop losses and forcing liquidation. Bloomberg terminal data shows that in hours leading up to this crash, open interest in silver futures actually increased substantially, meaning new short positions were opened right before prices fell. This is opposite of what you'd see in organic sell-offs driven by legitimate demand concerns. I need to address very real downside risks after a 36% crash because we must be realistic about what could happen next. Silver dropped from $120 to $78, representing massive technical damage, and momentum indicators have shifted, decidedly bearish short-term. If $75 support breaks, we could see silver test $68 to $70, and if that fails, possibly retest $50. Volatility is extreme, and anyone trading with leverage has already been wiped out regardless of whether their long-term thesis was correct. The $1.2 trillion in evaporated market cap represents a liquidation cascade where margin calls forced selling, triggering more margin calls in a self-reinforcing spiral. This is reality in leveraged futures markets, which is why physical holders without borrowed money can weather manipulated crashes without forced selling. There is also possibility that if we're entering broader risk-off, where liquidity tightens across all assets, precious metals could see additional pressure even though they're supposed to be safe havens. Bitcoin is down to 81,000. Equities show weakness, and if this develops into full deleveraging, everything including metals could get sold as investors raise cash for margin calls. However, here's why short-term technical risks don't change the fundamental structural thesis and why current price action creates the opportunity of the decade. That $36 Shanghai premium isn't weak demand or a broken market. It's desperate demand from buyers who understand that paper price and physical value have completely divorced. Physical buyers in China pay 46% over COMEX spot because they're front-running the inevitable squeeze when the paper manipulation machine breaks under physical delivery demands. They're not scared. They're loading up while Western investors panic and sell futures at a loss. The gold-silver ratio at 52 to 1 against a mining ratio of 8 to 1 screams that silver is massively undervalued relative to gold. Historically, when this ratio reaches extreme levels, it snaps back violently and silver dramatically outperforms during subsequent rallies. We're at one of the most extreme ratio levels in modern history. Vault inventories continue draining as paper price crashes, telling you everything about what informed institutional buyers actually do. COMEX registered inventories declined substantially over 12 months, and Shanghai Gold Exchange pulls metal from London vaults at accelerating rates. This isn't collapsing demand. This is unprecedented physical accumulation. Let me give you 3 critical takeaways about what just happened and what comes next. Number 1. The 36% crash in paper silver is a manufactured liquidation event with nothing to do with underlying supply and demand fundamentals. The Shanghai premium of $36.46 over spot proves the real market for actual metal operates in completely different reality than futures. Number 2. Fundamental ratios are at historic extremes that cannot sustain indefinitely. 52-to-1 gold-silver ratio against 8-to-1 mining ratio, combined with draining vaults and exploding physical premiums, creates the setup for a price explosion, catching most investors off guard. Number 3. Technical damage is real, and further downside is possible short-term, but this volatility creates the single best accumulation opportunity for physical silver in over a decade. If you understand the difference between paper manipulation and physical fundamentals, this crash is a gift allowing you to acquire real assets at temporarily suppressed prices. Here's what you need to do to position yourself ahead of what's coming. First, understand this is not the time for leverage or futures unless you have deep experience handling extreme volatility. Second, if you're building physical positions, these manufactured crashes are when you accumulate, not panic and sell. Third, watch Shanghai premiums and COMEX inventories because those metrics tell you when the physical squeeze begins, regardless of paper price. Subscribe to Bullion reports and turn on notifications because we'll track these developments and provide analysis, helping you make informed decisions in precious metals allocation. Hit that like button if this breakdown helped you understand what's really happening beneath this crash. Drop a comment with whether you think 78 holds or we're heading lower before the real rally begins. This is Bullion Reports. And remember, the critical difference between profit and loss in these volatile markets comes down to understanding the critical difference between manipulated paper price and true physical value.